The best time to plant a tree was 20 years ago. The second best time is now. Warren Buffett.
Hey, what's up, guys? Welcome back to another episode of Mentality. It's your boy Gambo, and I have a special guest with me today, Nick from Passiv. Today, we're discussing the importance of ETFs and the future of tech and wealth management. How has technology been disruptive in the industry? And how can you utilize technology such as passives to grow your portfolio? Stay tuned as we chop it up in another interesting episode. All right, welcome back to the show, guys. I'm here today with Nick, who is the Director of Growth at Passiv. And today we have a myriad of topics to talk about, but we really want to focus mainly on the importance of ETFs. We want to also talk about some of the potential futures of growth in wealth management, and of course, the use of technology in investment management today. So, Nick, thank you for being on the show. Nice to have you, man. How you doing?
I'm doing well. Thanks for having me. I'm excited to be here.
Yeah, man, absolutely. So, just from the introduction of topics, I know you run a business, and so we obviously want to talk about that in a little bit. But to kind of start talking about ETFs, I guess let's just start with the bare bones, like for our novice audience. What are ETFs?
ETFs are an acronym for exchange traded funds. So they're one of the two major types of investment funds that investors can buy, with the other one being mutual funds. ETFs are pretty much widely considered to be superior to mutual funds for three main reasons, I would say. The first reason is because they have better liquidity. So ETFs trade on a stock exchange just like stocks. So you can buy them at any time throughout the day, whereas with mutual funds, they only trade once per day. So ETFs offer better liquidity than mutual funds that way. The second reason is fees. So ETFs just have way lower fees than mutual funds structurally. I think they're cheaper to operate, so that's a factor. But I also think that mutual funds have been around for a lot longer. So there's a lot of mutual funds that kind of have legacy pricing built into their operations, so they're more expensive. And then the third reason why ETFs are better than mutual funds is because there's tax advantages. So with an ETF, you don't pay tax on the performance of that ETF until you sell it. You pay a capital gain based on whether it's gone up or down. And then with mutual funds, you actually have to pay tax on the performance of the fund each year for the duration that you own it. So mutual funds kind of offer that downside. So that's kind of 50,000 foot overview of why ETFs are getting so popular today. I'm happy to dive into any of the components in more detail if you want.
Yeah, no, for sure. I mean, I think just for the tax advantage perspective of that, I definitely want to delve into that. Before we do, quickly, just to kind of clarify, just to kind of make sure we lay, a pretty simple groundwork, so to speak, for people is, to my understanding, please correct me if I'm wrong, is ETFs and mutual funds, the idea behind them is basically that you have a bunch of different securities. So maybe you have a bunch of stocks, a bunch of bonds, kind of culminated, and then you're able to trade on that. So I guess what you're saying is ETFs are basically just different from mutual funds because ETFs are able to get in and out of a position throughout the day, right? So almost like if you're buying a single stock like Apple or Microsoft.
Yeah, they trade just like stocks do. You're right.
Right. So with the opposition of mutual funds being they trade it at the end of the day. So if you're in it, you pretty much are getting into it at the end of the day. Does that sound about right? Or
yeah. So with mutual funds, you kind of have to fill it like an order form, and then you don't actually know how many shares of the mutual fund you'll get until you get back your order confirmation. So when you buy a mutual fund, you basically say, I want to put $500 into this mutual fund. Right. And once your trade settles at the end of the day, they'll send you back a confirmation and say, hey, your $500 got you 3 units of the mutual fund or 10 units or whatever the units that you got were based on the price of the mutual fund at the end of the day.
Gotcha. So the execution is being executed at the end of the day whenever you full order with the order form.
Yeah, exactly.
Perfect. Cool. So I think now that we have that in the way, I think that's pretty helpful. Thank you for explaining that. What would you say to people who think ETFs are pretty dangerous compared to mutual funds? If you listen to the Dave Ramsey's out there, they pretty much preach mutual funds. But I think with a lot of younger investors, we're leaning more towards ETFs, mainly because I think ETFs are also a newer product, right? But what would you say to that?
Well, I mean, mutual funds and ETFs are not, there's not one that's necessarily inherently better than the other. It all kind of depends on what you're trying to achieve. So for ETFs, one of the big arguments against why you might not want to use ETFs is that since ETFs offer you better liquidity, there's more room to make bad investment decisions. So since you can trade ETFs throughout the day, there's lots of people who day trade ETFs and lose money because of that, because day trading is just really hard to do successfully. So yeah. ETFs offer you more optionality in how frequently you can trade them, but that's just a tool, kind of like a knife. Knives are great for cutting, bread,
I like
but
that.
if you
Yeah.
use them poorly, you can hurt yourself. So the
Yeah.
enhanced liquidity of ETFs are just a tool, and whether you use that for good or for evil is kind of up to you as the investor.
I guess so. Like, in what scenarios would you say like ETFs are better than mutual funds and vice versa?
Well, I mean, the three major reasons why ETFs are widely considered to be better than mutual funds is kind of like what I referenced earlier, I guess. So more liquidity, more tax efficiency, and lower fees. So if you can kind of capture those three advantages while still maintaining a long-term investment horizon and not trading in and out of your positions too much, I would say that that's why ETFs have kind of gained popularity because they're efficient if you use them properly.
Gotcha. So, like, let's just consider this scenario. I'm a brand new investor. I have no idea what I'm doing. Right. I come in the market. I just hear that trading individual stocks are not maybe the best thing for me to do. So maybe I want to go with a basket of stocks. I have ETFs as an option. I have mutual funds as an option. What would you say? I don't know if you want to like say you recommend something, but what would you say is maybe a smarter approach if you were in that position?
Yeah, so if you're just getting started, we kind of give the same advice to everyone. Invest in a diversified ETF portfolio that gives you exposure that's like sensible relative to your risk tolerance. So if you're younger with long time horizon, then it should be mostly invested in equities. If you're older and you're about to retire, it should have a lot more bonds in it.
Right.
And then just systematically contribute to that portfolio every time you get paid. So if you get paid biweekly, put some money out of every paycheck and pay yourself first by contributing to your retirement account. If you can kind of get those two major muscle movements nailed down, especially at a young age, then that's a lot of what is required to be a successful long-term investor.
Makes sense. So like I guess when would someone want to use mutual funds as opposed to ETFs?
Mutual funds are great for people who are worried that they might kind of overtrade their ETFs. So if you can get invested in a really low cost S&P 500 index fund that's kind of wrapped in a mutual fund instead of being wrapped in an ETF, then there's nothing really wrong with that. It's just there's a lot of mutual funds out there that have fees that are higher than what you might really want for something similar. And because ETFs are newer and there's just a bit more transparency to them, I would say on average, the fees on ETFs are lower than mutual funds. But that doesn't mean that mutual funds are bad if that's all that you can get access to or if that's just really what you want to be invested in.
Yeah, and I would actually agree with it. And I think also maybe for like a new investor, I think trading a mutual fund might seem like a little scarier just because like, you have to fill out the form and I don't know, it just seems like you're and using it in some trading platforms, I think will actually like, verify that you know what you're doing to even execute that trade. So it might be a little more intimidating as opposed to like an ETF, whereas like, you're pretty much just trading a stock. So it seems. So I think I agree with that. So I think with ETFs being like a new product, right? And we see that technology is pretty much becoming more and more prominent in the world of investing, and fintech is booming as a business. Where do you sort of see like the role of technology kind of like really shining for the investment world in maybe like the next 5-10 years to come?
I think it's just really going to empower consumers more and more to take their investments into their own hands. So you've seen a big kind of trend in the last 10, 15 years of people not using financial advisors anymore, but instead just managing their own portfolios through online brokerages and other online tools. Mm-hmm. Even things like, M1 Finance or Personal Capital or things like that are making it kind of easier and easier to take your investments into your own hand. And even to some extent, Passive, which is the product that we make, that's like kind of our mission as a company is to make DIY investing accessible to everyone. So we kind of primarily do that through software tools, but we're also big proponents of kind of the power of education. So we have a big blog where we do lots of like personal finance and investing education. And that's kind of for a lot of people, the big barrier as to why they're not investing already is not that they don't want to get started or that the tools aren't available to them. It's just that they don't know where to start. And there's like a knowledge gap. So that's an important part too. And technology is making it easier and easier to self-educate about how to get started investing, which is a big win for investors.
Yeah, and I think I would agree with that too. I think essentially like most people are just like they don't really know what they don't know. So that lack of education kind of makes people hesitant, or it kind of makes people feel like, oh, this is really not for me. It's like, over my head. It's really for those other people, and I probably shouldn't be tampering with this sort of thing. But I think investing it really should be for the everyday person, like, securing your future. And I think technology certainly is making that a lot much more accessible for people who otherwise wouldn't have that. Like if you look into the history of like us like investing, people typically had to go to a broker, get a brokerage account, sit down, pay fees, and that's all like almost like done away with now, right? Because we have these companies who are now making strides toward making this more accessible. Do you personally think that this is for the betterment of the industry, or do you think it's worse for the industry? And what I mean by that is people who otherwise wouldn't previously have access to the industry are now getting all this access. So they might not follow traditional rules of investing, and now they're like pretty much just hopping into this financial world. What do you think on that?
Yeah, I would say there's kind of like anything kind of depends on the individual. So it's never been an easier time to be an investor. You can go get a brokerage account and all of that easier and easier. We also have lots of data and educational resources, which when used properly are very beneficial for investors. But what do you think happens when investors all of a sudden have unprecedented access to information? They get the news headlines in their pocket and they can day trade stocks on their cell phones. Well, it kind of like has never been easier to be a bad investor as well as just being an investor broadly. So if you can have some discipline and try to make basically avoid making long-term investment decisions based on short-term emotions, then I think that technology overall has been a big benefit to the investment community.
Right. Yeah, I think that's a good point. I mean, I think maybe somebody might beg to differ if they were, I guess an executive of a hedge fund, so to speak, based on the recent events that we've kind of seen with, things like silver going up and GameStop and Dogecoin. These are some of these crazy things that are happening. Like, do you have any thoughts on that? Like, would you say that's also a derivation of mass access to the financial world?
I would say it's partly because of that. I also think a big reason why the whole GameStop thing happened. So for anyone who's unfamiliar, basically a bunch of investors on Reddit kind of banded together to execute one of the world's most unanimous and deliberate short squeezes. So they put some hedge funds out of business by driving the price of GameStop up so that people who were short it lost all their money. So I think, honestly, an underrated contributor to that is just sheer boredom. Everyone's on quarantine right now and they have nothing to do. So this is kind of, for a lot of people, replace social activities, I think. And if you just look at the volumes being processed by brokerages and stuff, I think that when sports teams all were forced to stop playing and when people had to work at home and couldn't go out and do social activities, investing in the stock market kind of became a hobby for a lot of people. And hopefully that results in positive long-term habits for people and it doesn't stop once the coronavirus pandemic is over. But that's kind of, I think, one thing that's contributed a lot to that trend.
Yeah, that's a good point. I didn't even think about it from the perspective of COVID, kind of like becoming something that people were like now gravitating towards investing. Certainly a solid point. So in regards of I think we kind of established that technology is pretty much helping people gain access. It's making things a lot much more efficient in the investing world. It's also creating, I guess, I don't want to say it's created issues, but it's sort of like disrupting the status quo, which is a good thing for some people, and for some people, they might not be too happy with if they're wealthy. Like with Passive, can you talk a little bit more about what exactly that you guys do? So from my understanding, you're helping people put together individual stocks together, and then they can kind of use that automatically. Instead of using like Excel sheets, they can use that as their basket of stocks and trade directly on the market. Is that sort of correct?
Yeah, so Passive is basically designed to be a rebalancing engine that pairs directly to your brokerage account. So the whole idea is that you spend some time at the outset configuring what you want your portfolio to be invested in, and then Passive will monitor it, and whenever you drift from that target portfolio, we'll send you a prompt so that you can log in and rebalance your portfolio with one click. So we do all of the legwork that tells you what you need to trade to get invested back into your target portfolio, and then we send the trades off to your brokerage, they get executed, and they send us back trade confirmations. So that's like the 50,000-foot overview of what we do.
Okay. Now, I guess I'm assuming you're not like advising people what stocks to pick in this portfolio, correct?
No. So in order to use Passive, you kind of have to be comfortable self-educating to the point where you can actually create a target portfolio for yourself. And then once that's done, Passive is like the best tool that you can use to make sure that your portfolio stays on track. So the idea is that you do a bit of legwork up front, and then it's basically your portfolio is automated for the rest of your investment lifetime.
Right. I guess so. Like, what is sort of like the difference between if an investor is thinking about using Passive, what is sort of like the difference between you and say an M1 Finance?
To my understanding, M1 Finance doesn't actually execute your trades for you. They're just more of like an aggregator that allows you to read in all of your account information from different places. Passive is actually like doing the trades for you. So you can pull in, let's say you had some of your investments at TD Ameritrade and some of your investments at Interactive Brokers. You could link Passive to both of those accounts and rebalance them all with one click.
And like, is how are you doing? Is that like I don't maybe necessarily need to get into the nitty gritty of the technical aspects of it, but is that are these like API calls? Like, how are you kind of pulling that together?
Yeah, so we have native API integrations with all of the brokerages that we support. I don't know if you've ever like signed up for a new service and there's like sign up with Google.
Yeah,
You know what I
yeah,
mean?
yeah.
So that protocol that allows you to sign up for that account with your Google account is called OAuth. And it's kind of like the most secure and stable way for you to connect two software services together. And that's the same protocol that we use to connect to your brokerages.
Nice. So the idea is almost like one safe space to kind of see your entire pool of investments and making decisions based on everything that you kind of have and all these different, maybe say brokerages and different accounts. You kind of get a full overview of everything that you kind of own, and you can make the best decisions based on that.
Yeah, exactly.
Yeah, I think that's super convenient. Like, who would you say your product is like geared towards, and who would you say is the most beneficial for?
Yeah, I mean, we're basically serving right now primarily investors who are saving money in the accumulation stage. So if you are working and you're putting money into your investment account every month or every week or any kind of period whatsoever, then investment's kind of a really useful product that you should try out.
Okay, so I guess like another thing would be like if I'm an investor, like why should I use passive as opposed to like I don't know, kind of just monitoring all my accounts, or why should I not just put all this in Excel file, like or maybe some other file that I can easily track?
Passive, if you're using Excel to manage your portfolio already, will save you a ton of time. I can guarantee you of that. And the reason why is because we don't just do the trade calculations for you, we actually do the trade. So you might use Passive to monitor your portfolio and figure out what you need to buy or sell to get back on track. But you still have to go to your brokerage and you still have to kind of place all the trades one by one. You also have to remember to log in and do this. So with Passive, once your account's paired, we check your account every day to see whether it's drifted from your target portfolio. And if it has, we just send you an email. So it has both monitoring and a lot of time saving stuff built into it.
Interesting. So you guys are actually executing the trades on behalf of the user. Am I getting that correct?
No. So when you drift from your portfolio, the email that we send you still prompts you to log in and make the trade. So the final trade authority always lies in the hands of the user. Mm-hmm. And that's kind of like something that just from talking to our user base, people seem to prefer it that way because these are people who want to be somewhat hands-on, but not to the point where they have to go in and manually check things on a regular basis.
Gotcha. Okay, so you're just pretty much sending alerts when say I have my portfolio percentages, maybe say 50% stocks, and maybe 20% bonds and 30% commodities, whatever, right? You're pretty much just like letting me know if I drift from my 50% stocks and I end up being like 61% stocks. You kind of send me an alert saying, hey, Isaac, your portfolio is now 11% over what it should be. Is that sort of right?
Yeah, exactly. So once you log in, like let's say you go to 60-40 from 50-50, we'll send you an email that says, hey, your portfolio is drifted. Click here to log in. And once you click through and log in, then you'll be prompted with a trade recommendation that tells you to sell some of the 60 to buy some of the 40. And if you click rebalance, then we'll do all the trading for you and you'll get back to 50-50.
When you say you do all the trading for you, do you mean like it kind of tells you like how many shares to sell of something or what?
Yeah, so you get like a trade preview that pops up and says, we're recommending that you sell this much of this thing and buy this much of this other thing. And then if you hit trade, then we'll execute those trades for you.
Gotcha. That sounds pretty convenient, actually. Do you work with all brokers or are there brokers that you do not work with? Who do you work with?
Right now, our main integrations are with Interactive Brokers, TD Ameritrade, Questrade, Tradier, Alpaca, Wealthica, and we're working on integrations with Zerodha, which is the largest brokerage in India, and Kraken, which is actually a cryptocurrency exchange. So once the Kraken integration is launched, probably in 2 months or so, we will be like one of the best places that you can go to create your own custom cryptocurrency index fund.
Nice. Are you guys looking to outside in the world of stocks? Are you guys looking to pair up with other brokers? Like, I don't know if you're at liberty to kind of speak to like what some of the brokers you guys are thinking about working with.
Yeah, I mean, we have kind of relationships in various stages of maturity with a bunch of different brokerages. I will say, if anyone who listens to this who works in the brokerage space and you're not integrated with us already, we'd love to hear from you. We're an integrations company at our core, so we are always looking to integrate with new brokerages, and I'd be happy to hear from any of you.
Nice. And I'm assuming, do you use Passive yourself, obviously?
Yeah, I do. I use it to manage my own portfolio. And actually, I did before I joined the company as like a full-time employee.
Nice. Okay, I mean, so Passive, right? This is Passiv. And
there's no E on the end of Passive, you're right.
Very interesting. So I guess like if you wanted to, is there a fee attached to Passive? I can't imagine you guys, are doing this for free. So like, what is that like?
Yeah, we wanted our pricing to be as simple and as transparent as possible. So there's two ways to use Passive. There's a free version with limited features, and there's a paid version with all the features. And the paid version is just $99 a year paid with your credit card. So we never take any money out of your brokerage account or anything like that. It's just paid with your credit card like you would for your Netflix subscription or something like that.
Okay. So are there tiers to your payment plan, or is it just like one for all?
Just one type of paid pet plan. That's it. We have free and paid, and that's as simple as we wanted it to be.
Nice. And what does the free version kind of give you access to?
It's basically like read-only access to Passive, so you can still aggregate all your accounts and read all your information, but you can't actually do the trades with one click. So that's a paid feature. That's like the main paid feature, I would say.
Can you explain like that a little bit more? I'm sure. I mean, I know you touched on it, but like the trade feature.
Yeah, so basically, if you were on the free version of Passive and you linked up all your brokerage accounts and set a target portfolio, we would tell you the trades that you need to make, but you couldn't actually make them within Passive. You would have to log into your brokerage's portal and make all the trades one by one.
Manually. Okay, gotcha. That's pretty fair. I mean, I think it'll probably give people a good idea of whether they like the program or not, and if they want to continue to use it, and you just go for the paid version. I'm assuming that's probably the intent behind that, right?
Mm-hmm, exactly. We thought it was important to give people the opportunity to try it and see if they liked it before they paid.
I think that's reasonable. So Passive, that's at passive.com, right? So passiv.com. If you want to get started, just go on there and just check it out.
Awesome.
Yeah. So companies like Passive, right? What you guys are doing is pretty much is implementing technology in the industry, in the financial industry. Do you think your company is disruptive?
Yeah, I mean, our hope is that we basically give people time back so that they can spend it on things that are more useful than kind of tracking their portfolio in a spreadsheet. So to the extent that we can kind of disrupt that use of Microsoft Excel or whatever other spreadsheet software you're using, that's something that we're really happy to do.
Where do you see yourself in the future of wealth management as a whole?
Yeah, I mean, ideally, we would like Passive to kind of really be integrated broadly across the globe with all the major brokerages. And we'd like, there's a long list of features that we'd like to build that we just don't have time or capacity for right now. So as long as we can kind of keep integrating with new brokerages and keep proceeding down our product roadmap, that would be a big win for us, I would say.
Gotcha. Cool. Again, I think technology as a whole, we know is just only going to grow. And the financial industry is seemingly ever growing. Like, what are your thoughts on companies like Robinhood that have made this industry very, very accessible? Is that something that you think Passive would also be able to achieve?
Yeah, I mean, I mentioned this earlier, I believe, but our mission as a company, just to reiterate, is to make DIY investing accessible for everyone. So we want to lower the barrier to get started in investing, because I think anyone who's listening that does a bit of investing will probably attest to this. It's not that hard to stay the course once you've already started. It's just that first step is the hardest part. So we want to kind of lower the bar for that to the extent possible with educational resources and software tools. And the more that we can do that, the more that we're kind of furthering our mission as a company.
So, makes sense. I guess when it comes to, ETFs, I think we kind of briefly mentioned that one of the advantages was pretty much, that is advantageous when it comes to taxes. Can you kind of delve into that a little bit more so people kind of understand why that is and how exactly that works?
Absolutely. So when you're invested in an ETF, you buy it at one price and you sell it at another price. So let's say you buy it for $10 and then in 10 years you sell it for $50. You don't pay the tax on that $40 capital gain. So the capital gain is just the difference between your sale price and your purchase price. You don't pay the tax on that until the year or the moment that you sell it. So you can kind of defer your taxes from your investments in your ETF as long as possible, assuming that you can kind of stomach that long time horizon. With mutual funds, every year that you are invested in the fund, you get issued tax forms that you have to pay taxes on. So, if your fund goes up, you have to pay those taxes immediately, which kind of makes it harder to be a long-term investor. And with ETFs, if you actually hold those ETFs until the time that you pass away, I believe you don't have to pay tax on it at all. So check with a tax professional for that, because I'm about 70 or 80% sure that that's the case, not 100%. So if you're thinking about kind of planning for your family's finances, be sure to double check that. But there's lots of kind of ways that you can defer your taxes on ETFs that's not possible if you were invested in a mutual fund instead.
I would say, I guess, is that still true even if you were in, say, in a tax advantage account, maybe say if you're in a Roth IRA or anything like that in the US, would you know if that still would be true?
Yeah, so if you're in a Roth IRA or a 401k, you don't pay tax like ever on your investment gains. On a 401k, you would pay taxes on withdrawal, of course, but that doesn't matter whether you're in an ETF or a mutual fund. So definitely that's not as important of a consideration if you're in a tax advantage account, but for taxable accounts, it matters a lot.
Right. And I guess like also like, so ETFs do have like expense ratios, right? Like they have like fees, but they often tend to be a lot lower than mutual funds. And I guess that's where some of the savings are.
For sure. So mutual funds generally charge like around 1% of assets under management. So if you invest $100,000, you pay $1,000 in fees each year. And ETFs can be like as low as a few basis points. So a basis point is a percent of a percent. So if you're paying 5 basis points, then on $100,000, you would be paying $50 a year. So that's $950 of savings, and that's actually pretty representative of what the cost differences would be between a mutual fund and an ETF. They're usually about 50 to 100 times higher in a comparable mutual fund versus the same ETF.
And are these fees usually coming on the front end or the back end?
They don't come out like on transactions. They just come out of the fund every year. So it just is like automatically deducted from your investment performance. So if your fee is 1% and the fund returns gross of fees 6%, then your return net of fees is 5%, which is just, your actual fund performance minus the fee. That's what you get back kind of after everything as the investor.
Yeah, that's crazy. I think that's something that I think also people don't really usually take into account when they are placing trades, right? Especially now with like, companies that are leveraging technology, and so you're not really having to pay the transaction fees. Like, back in the day, it's something you have to really think about. If you're gonna buy a share of something, or you're gonna sell it, you really have to thought about the cost, and you also have to think about the expense ratio. You have to think about the fees, whether it's actively managed or passively managed. So I think it's still helpful. Like, I guess like one question would be from passive, like, do you currently have a feature where it kind of tells you like, what your expenses might be on a certain trade or not? Or is that something?
Yeah, so on trades, we show like a commission preview before every trade. So nice. Before we actually rebalance your portfolio exactly what you'll pay in fees if you proceed.
Oh, that's huge. Because I really don't think a lot of people are paying attention to that.
It's super important. It makes a big difference in your long-term performance. So it was an important feature for us to include. Yeah,
absolutely. I think I wish I had like numbers prepared, but I know like, that there are a lot of examples out there that kind of show, what your overall gains would be, with a couple percentages off, in expenses. And, like 1% can seem like a little, but that's like a lot when it comes to like, investing. So I think having those basis points definitely like helps grow your gains. So thank you for that. Do you have any other advice for anyone who's, looking to start and invest in and, is just not sure, about like, where to get started, how to get started, what kind of advice would you give to somebody?
Yeah, I mean, we try to make our website as educational as possible. So if you want some good resources on how to get started, just check out our website at passiv.com. That's passiv.com. Awesome.
Well, look, Nick, thank you, man. I think I learned a ton today, and it was like really nice to just kind of have you on here to talk about some of these things and share the functionality of Passiv with us. Something I certainly will be checking out. So thank you for being here, man. It was a pleasure. Do you have any other last words?
No, thanks. Thanks again for having me. And maybe in a year or so, once we've got some more stuff done at Passiv, we can kind of circle back and do this again.
Yeah, absolutely. I'd love to know what you're working on next.
All right, awesome.
Man. Until next time, check us out on Instagram, Mentality Radio, and listen to our podcast on Apple Podcasts, Spotify, wherever you listen to your podcasts on. And until next time, thank you for listening. Deuces.